Gold and silver are not correcting. They are not pulling back. They are collapsing in real time, and most people have no idea why. This isn't panic selling. This isn't bad news. This is forced liquidation, margin weapons, and a system under stress right now. While headlines distract you, something far more dangerous is unfolding beneath the surface. In this video, I'm going to break down exactly what's happening, who benefits, and what signals actually matter. If you want real market mechanics, not noise, subscribe to Economic Mechanics. Hit like to support the channel, and watch this closely. Gold and silver are not pulling back. They are not correcting. They are not consolidating. This is the kind of move that happens while you're staring at the screen, refreshing, watching numbers tick lower every few minutes. 4,600 breaks, not later, not tomorrow, right now. The wash selling is exhausted. The weak hands are gone. The bottom is in. That's what people always say after a historic down day, because people want pain to be over. But markets don't care what people want. Forced liquidation. Margin calls firing one after another like a line of falling dominoes. Counts being wiped out not because traders were wrong on fundamentals, but because they ran out of time and cash. Positions closed automatically at the worst possible prices. And the key detail most people are missing: it's accelerating. Welcome to the hidden economy. The part of the market most people never see until it's too late. While headlines talk about politics and earnings and distractions, this is where the real damage is happening. Over the weekend, thousands of traders held silver ETFs thinking they would exit Monday morning. They never got the chance. When markets opened, sell orders were rejected. Circuit limits breached. Prices were still below the allowable bands from Friday's collapse. The exchange simply would not accept sell orders. Imagine watching your position bleed while the exit door is locked shut. That is not theory. That is happening. Gold is breaking through 4,500 as this happens. Silver slicing through 72. People refreshing their screens, watching values evaporate, unable to act. This is how crashes actually feel. Not dramatic headlines after the fact, but helplessness in real time. Most people think crashes are caused by bad news. They're not. Crashes are caused by structure, leverage, rules changing at the worst possible moment, when everyone is forced to do the same thing at the same time. Sell. This is not a story about fear. It's a story about mechanics, about how markets are built and how they break. Traders didn't wake up and suddenly decide silver is worthless. The fundamentals didn't collapse overnight. Demand didn't vanish. Supply didn't magically surge. What changed was pressure. Pressure applied through the system in a way that gives participants no choice. When selling is voluntary, markets move in steps. When selling is force, markets fall downstairs. So traders survived the first hikes. Then another came. Then another. Christmas. New Year's. No relief. No pause. Then January 13th changed the rules entirely. And just when people thought the damage was done, another hike hit after Friday's massacre. Then another this week. For context, the entire year before this saw 2 margin hikes. The year before that, 3. 7 hikes over 3 years was normal. 8 in 8 weeks is extermination. This isn't about risk management anymore. This is about removal. Each hike drained more cash from long positions. Each one reduced the number of traders able to survive the next. By the time the crash accelerated, many traders weren't wrong. They were simply out of ammunition. And here is the key detail most people miss. Margin hikes Dan-T hit everyone equally. Institutions with deep pockets absorbed them easily. Retail traders cannot. Smaller funds cannot. Smaller funds cannot. Family offices cannot. This weapon selectively destroys the weakest balance sheets first. That's why price collapses look sudden. The pressure builds quietly, invisibly, until one more hike pushes the system past its limit. When you see silver down nearly 40% in a day, you are not seeing people change their minds. You are seeing accounts being closed by force. And once that process starts, it doesn't stop because it should. It stops when there is nothing left to liquidate. That is the engine driving this crash. Here's the part that should make you stop and look up from the screen. The same day margins were raised in Chicago. Margins were raised in Shanghai. Same direction, same intent, same timing. Let's be clear about how abnormal that is. The CME in the United States and the Shanghai Gold Exchange do not coordinate policy. These are not friendly institutions. Their governments are economic rivals. They clash on trade, on technology, on currency policy, on everything that matters. They do not move together unless something is very wrong. Yet here they were, 14 time zones apart, pulling the same lever on the same day. That does not happen unless both sides are afraid of the same outcome. And that outcome isn't price volatility. Exchanges don't fear volatility. They profit from it. What they fear is failure to deliver, a loss of confidence in the system itself. To understand why, you have to look at the structure beneath the price, not charts, not sentiment, structure. On the surface, silver trades like any other commodity. Underneath, it's a fractional reserve system. For every ounce of real silver sitting in a vault, settle in cash and never ask for metal. But when too many people ask for delivery, the math breaks. Right now, that ratio is extreme. That alone is unstable. But instability becomes crises when physical starts leaving the vaults. And that's exactly what has been happening. In January, tens of millions of ounces didn't just change ownership on paper. They were physically removed, loaded onto trucks, gone. In 1 week alone, more than a quarter of the available inventory vanished. Not traded, not rehypothecated, removed. This is not retail behavior. Retail investors do not move silver by the truckload. This is institutional demand, manufacturers, sovereign buyers, entities that need metal, not exposure. While paper prices were collapsing, physical was being drained. Now look forward to March. This is where everything converges. March futures represent an enormous amount of promised silver, far more than exists in the vault system. On first notice day, every holder must choose cash settlement or physical delivery. If only a small fraction choose delivery, the system is stressed. If a slightly larger fraction does, it breaks. That is the scenario exchanges exist to prevent at all costs. So what do you do if you are staring at a delivery window you cannot fulfill? You reduce the number of people who can demand delivery. You raise margins. You force liquidation. You shake out longs before they get the chance to ask for metal. This is why the margin hikes matter. This is why the timing matters. And this is why coordination matters. They are not trying to lower the price because silver is overvalued. They are trying to lower participation. They need fewer contracts standing when delivery arrives. And here is the detail that confirms it. Paper silver in New York is collapsing. Physical silver in Asia is not. The same ounce of metal is trading at radically different prices depending on whether it's a promulus or a bar. That divergence should not exist in a functioning market, yet it's growing. If this were a real crash, driven by demand destruction, physical buyers would step back. They're not. They're paying up. They're accepting premiums. They're draining supply while paper traders are being forced out. One market is reflecting stress, the other is reflecting reality. And when enemies move together to suppress one side of a market while the other side holds firm, it tells you the problem is not price, it's delivery. That's what they're trying to avoid. If this were a real crash, there would be no debate. Supply would be overwhelming demand. Buyers would disappear. Physical prices would fall with paper. That's how markets work when moves are honest. That is not what is happening. Right now, paper silver is trading in the low 70s. At the same time, physical silver in Asia is changing hands near 100. Same metal, same day, same planet. Nearly 40% difference. That gap is not noise. It is a confession. Ask yourself a simple question. If silver were truly worth the paper price, why would anyone pay that much more for it elsewhere? Especially not sophisticated buyers, not manufacturers, not institutions that count costs down to the last basis point. They wouldn't. They don't overpay unless they have to. They are paying up because the paper price is not accessible. You cannot build solar panels or electronics with futures contracts. You cannot meet production schedules with ETFs. You need bars and need delivery. And when delivery is scarce, price behaves very differently. This is why the gap matters more than the chart on Friday. The gap was large. After the crash it didn't close. It widened and paper fell harder. Physical health. That tells you everything about which market is lying and which one is under stress. And here's the part that should make you uncomfortable if you're still convinced this is just a correction. Institutions are paying extreme rates to borrow silver. Lease rates have voted. Normally, Borrowing silver costs almost nothing. Right now, it's expensive. Desperate, expensive. You don't pay those rates if you expect prices to collapse. You pay them when you need metal now and you can't find it. At the same time, vaults continue to drain. Not slowly, rapidly, week after week. Metal leaving while price falls is not bearish. It is the opposite. It means someone with size and patience is using forced selling to accumulate physical supply. While retail traders panic, institutions are backing up trucks. And while this is happening, look at who benefits from collapsing paper prices. The largest short positions in silver belong to major banks. Every dollar down transfers enormous sums from leveraged longs to entities that can survive unlimited margin hikes. This doesn't require conspiracy theories. It requires incentives. The players with the most influence over exchange rules are the same players best positioned to benefit from forced liquidation. That alignment alone should make you skeptical of the narrative you're being sold. Add to that the timing. Questionable headlines. Leaked policy stories. Algorithm-driven selling triggered by information that is later walked back or denied. Markets don't reverse for corrections. Once the cascade starts, the damage is done. Then, there's the options market. Heavy put buying appeared just before the crash. Someone positioned aggressively for exactly this outcome. Either they guessed perfectly, or they had visibility into what was coming. And when traders tried to escape, many couldn't. Funds halted, platforms froze, orders rejected, accounts inaccessible. The price collapsed first, the exits closed second, the rules tightened third. That sequence is not accidental. If you were designing a system to strip leveraged traders out of a market before a critical delivery window, this is exactly how you would do it. The most important takeaway is this: nothing about this collapse aligns with the fundamental picture. Supply deficits remain, industrial demand continues. Export restrictions tighten availability. None of that vanished overnight. The only thing that collapsed is the paper price. And paper prices can be pushed around when leverage is high and rules change suddenly. Physical reality cannot. That divergence is the smoking gun. One of these prices is wrong, and history is very clear about which one eventually wins. This is the part most people never think about until after the damage is done. Crashes don't just destroy wealth, they redistribute it. Money doesn't vanish. It moves from the accounts that are forced to sell to the ones that can wait. Friday, that transfer happened at scale. Retail traders lost months, sometimes years, of capital in a single session. Institutions on the other side of those trades booked windfall gains. Not because they predicted the future perfectly, but because they were built to survive the storm. That's the uncomfortable truth about markets like this. Being right is not enough. You can understand the fundamentals, see the shortages, believe in the long-term story, and still be wiped out if your position size or leverage dosage allow you to endure forced moves. This is why bottoms are never clean. They are chaotic, violent, emotionally exhausting. They are designed to break conviction before resolution arrives. So what matters now isn't guessing the exact low. Anyone claiming certainty about price targets in an environment like this is lying, to you or to themselves. Support levels mean nothing when liquidation is the driver. Charts don't stop margin calls. What matters is watching the signals that tell you whether stress is easing or intensifying. The first is the physical premium. That gap between paper and physical is the truth meter. If physical collapses to meet paper, then demand is breaking. But if paper eventually rises to meet physical, it means the paper market lost credibility. The direction of that convergence tells you who's winning. The second is vault inventory. Every ounce leaving the system increases pressure on future delivery. If withdrawals continue at the current pace, stress doesn't disappear. A shrinking buffer makes every contract more dangerous. The third is lease rates. When borrowing metal becomes expensive, it signals scarcity. Institutions don't pay high rates unless the metal is needed now. That urgency is not bearish. It's a warning light. Then there is open interest. Are traders truly giving up, or are they holding through pain? Elevated open interest, going into a delivery month, increases the risk of confrontation between paper promises and physical reality. That is what exchanges fear most. Finally, watch the system itself. Trading halts, fund suspensions, account access issues. These are not normal features of healthy markets. They appear when stress exceeds capacity. Here is what panicked traders miss. This is not about courage, it's about construction. Positions that rely on leverage are fragile by design. They require cooperation from the system. When the system turns hostile, leverage becomes a liability, not an advantage. The traders who survive events like this aren't the boldest or the smartest. They're the ones who size their exposure to survive being early, being wrong temporarily, and being pressured by forces outside their control. At some point, paper and physical have to reconcile. They always do. You cannot print metal. You can only promise it. History has resolved that conflict the same way for thousands of years. The only unknown is how much damage occurs before that reconciliation happens, and who is still standing when it does. Right now, paper prices are screaming panic. Physical prices are whispering truth. Institutions are positioning quietly. Retail traders are being forced out loudly. When clarity returns, it will feel obvious in hindsight. It always does. The question is simple and uncomfortable. Are you positioned to survive long enough to see it?